I've been working in the financial markets for more than 2 decades. For the first half of my career or more, I worked in the investment management industry, and for the latter half of that stage of my career, I focused in particular on US stock markets, and that is perhaps even today what I am best known for. I have been out on my own for the last 7 or 8 years. I have lectured in all major Irish universities and also across the globe for Manchester Business School worldwide. However, perhaps I am best known for my weekly column in the Irish Times entitled Serious Money. I have a number of investment clients and I engage in public speaking on a regular basis. Well, the first point to note is this. The term or word secular derives from the Latin seculum, which means long periods of time. Stock prices and stock returns are actually reasonably predictable over long horizons of 10 to 20 years or more. In fact, if we look at US stock market returns over the past 2 centuries dating back to 1802, there has in fact been 7 secular bull markets and 7 secular bear markets. At the present time, we happen to be more than a decade into the 8th secular bear market, and people who have been observing financial prices or stock prices in recent years will note that stock prices today are no higher than they were at the peak of the dot-com bubble in the spring of 2000. The damage done in secular bear markets is quite severe. If one looks at the historical data, all of the good returns and positive returns have been earned during secular bull markets. The median return, believe it or not, is 12.5% after inflation. If we looked at the median return during secular bear markets, it's minus 1%. Just to give you an indication, the Dow Jones was first listed, or a first price was given for the Dow Jones Industrial Average in 1896. If you were fortunate enough to, well, live that long to the present day, but secondly, if you were fortunate enough just to invest in secular bull markets, in other words, you missed the secular bears, you were out completely, well, the Dow Jones started at 40 points. Today, it will be north of 70,000 points if you were invested simply and solely in bull markets. And this is secular bull markets. But what about for secular bears? Well, if you were unlucky enough to invest in simply secular bears, the Dow Jones Industrial Average would have gone from 40 points to less than 20 points today. The damage is quite severe. Throw in inflation on that and you've lost 90–95% of your money. Admittedly, it doesn't include dividends, but as I said before, the real returns over time are negative. Well, a defining characteristic of secular bull and bear markets is a trend in valuation levels across these periods of time. Through secular bull markets, investors become willing to pay more for a unit of trend earnings. Actually, if you look at the last cycle, the secular bear market ended in the autumn of 1982 at 7 times trend earnings. During the spring of 2000, it peaked at 40 times trend earnings, which actually was far higher than the peak in 1929. Today, and in March 2009, we troughed at roughly 12 times trend earnings. And believe it or not, we are north of 20 times trend earnings today, which actually is bubblicious territory. Some investment commentators are making the case that the market is cheap at current levels. Well, they are using price-earnings ratios based on current earnings or 1-year forward earnings. The fact of the matter is that this is a classic example of thinking this time is different. That is dangerous thinking and usually leads to capital loss. So why is valuing the market on current or 12-month forward-looking earnings a mistake? Well, the fact of the matter is that earnings move with the business cycle. Take a cyclical stock like Ford, for example. Okay, the S&P 500 may not be as cyclical in terms of earnings as Ford, but it's cyclical nevertheless. So let's take a look at Ford. Its earnings grow substantially through an earnings expansion. And at the peak of the cycle, you will typically find that the stock is trading at 4 to 5 times earnings. Does that mean it's cheap? Well, absolutely not, because earnings are set to collapse during the coming economic downturn and recession. On the other hand, if we look at it during a recession, earnings could actually be negative. Or if they remain positive, it could be trading at 100 times earnings. Does that mean the stock is expensive? Once again, absolutely not. Earnings are set to recover through the economic recovery and expansion to come. This is exactly the same dynamic at play with valuations for the S&P 500. Earnings collapsed to $40 a share at the recent trough. They've more than doubled now and are expected to hit roughly $95 a share this year, which is close, if not an all-time high. Those earnings are clearly influenced by the business cycle. This time round, they've also been influenced by corporate America's determination to keep a lid on costs. However, if one is to do a proper and thorough analysis of what is the true underlying earnings power of the S&P 500, it is closer today to $65 a share than it is to $95 a share. Thus, if we value the market on that basis, it is currently trading at close to 20 times. And as I said previously, these are bubblicious valuations. The advance in stock prices since last autumn is almost exclusively attributable to Ben Bernanke's release of the idea or notion that they were going to engage in a second round of quantitative easing. In fact, the positive correlation between stock prices and the Federal Reserve's balance sheet, the size of the Federal Reserve's balance sheet, is plus 0.7. Now, what I find interesting and somewhat concerning about the Federal Reserve today is that Ben Bernanke is on television judging the success of quantitative easing on the basis of higher stock prices. He got on the television and said, large cap stocks are up, but small cap stocks are up even more. It is absolutely unfathomable to believe that a central bank whose primary objective is price stability is now on television saying that their primary objective is higher stock prices. I think the reason why financial markets, or certainly stock markets, haven't fallen as much as one might expect is, number one, faith in the Federal Reserve, and in particular Ben Bernanke. Is we've had quantitative easing, we've had QE1 followed by QE2, and investors are saying, well, there might be a QE3. In other words, that Ben Bernanke will do anything in his powers to push stock prices higher, and certainly do anything to prevent them from falling. That will ultimately prove to be an incorrect assumption. Okay, the second thing to notice is that at the moment investors are pretty bullish. They're pretty bullish in the outlook. Is earnings estimates had been going up. They've now started to plateau and are starting to come down. That was helping to push the market higher. Similarly, economic data in recent months has been almost uniformly ahead of expectations. We're starting to see this change as well. So the environment underneath is changing. Now, I'm not calling for a double-dip recession or a recession in the immediate future. Nothing like that at all. But also, let's take a look back to 2007. Everybody seems to think that this subprime crisis somehow, crept up and launched itself unannounced on the financial markets. It was bubbling for months, and the markets paid no attention. First of all, we had a couple of hedge funds went bust, and month by month there was another development. At the time Ben Bernanke was talking about losses being contained within the region. I don't know, it was something like $100 million or something. As we know, it turned into billions. I think that investors, and remember, the only constant in markets is human nature. Human nature never changes, and what we're seeing right now is, certainly I believe, is investors are in denial. Investors are clinging to the hope that we've entered a normal economic cycle. This is anything but a normal economic cycle. It's been boosted by artificial government stimulus, and that's coming to an end too. So we could have QE2 coming to an end. QE3 is not as certain as people think. Government stimulus coming to an end. Then we'll see how will the private economy do standing on its own 2 feet.